Stock options can make you a lot of money. They can also get you into a lot of trouble. When you first start trading options is actually one of the most dangerous times. This is when you know enough to place trades, but don't have enough experience to be fully aware of all the risks involved. Options are not just bets on direction, they are sensitive to many forces at once. Time, leverage, liquidity, volatility, interest rates, scheduled events, and unscheduled ones. All of these tug on an option's price at the same time. If you're going to trade stock options, you need to keep an eye on all these sources of uncertainty. In finance, we call them risks. If you want to survive trading options, you need to be aware of all the forces acting on your position and be prepared for how quickly conditions can change. Our stock options course exists for one reason: to make sure time, volatility, and leverage work for you, not against you. Because ignoring risk does not make it go away. It just makes it expensive. When you buy a share of stock, you can hold it for years. Even if the company struggles, the shares don't go anywhere. You still own them tomorrow and next year. Options are different. The moment you buy a stock option, the clock starts ticking. Options expire. Every option comes with an expiration date. This is a real deadline, even though traders don't typically plan to hold their options until expiration. They usually close the position early by trading with someone else. But someone is holding the option at the end. And if you are the last one holding that contract when it expires out of the money, you've lost. An expired stock option is worthless. Remember, there are 4 basic option positions: long call, long put, short call, and short put. When you buy a call option or a put option, you now have a long position. For long option positions, time is your enemy. As time passes, this relentless force applies downward pressure to the option's value, even if nothing else changes. Time, of course, only moves in one direction. Stock prices, however, can move either up or down. And that is its own source of uncertainty. We call this directional risk. Every option position reacts differently to price movement. If the stock rises, long calls gain value because the right to buy becomes more valuable, and short puts gain because the risk of having to buy stock fades. On the flip side, long puts and short calls lose value. They're on the wrong side of that move. If the stock falls, long puts gain as the right to sell becomes more valuable, and short calls benefit as the risk of selling stock fades. In that scenario, long calls and short puts lose value. That mapping is predictable. The risk is choosing the wrong exposure. Options don't remove directional risk, but they let you pick which price moves work for you and which work against you. Small moves in a stock price can result in large swings in an option price. This is leverage. You love it when it makes you money, but it cuts both ways. Here's a real-world example of a stock and one of its stock options. The stock was trading at $267.92 per share. A 275 call option that expires in 46 days is trading at $6.60. If the stock goes up $1 per share, then the option premium will go up 44 cents. So let's calculate the percent change in the stock and the percent change in the option. A 0.37% increase in the stock results in a 6.70% increase in the option premium. In other words, the option reacts about 18 times more than the stock. There's your leverage. The option acts like a financial lever. A small move on the stock side produces a much larger movement on the option side. Many investors are drawn to options because of the power of leverage. It magnifies gains, but it also magnifies losses. In finance, we call the trading activity liquidity. When an option trades frequently, lots of buyers, lots of sellers, we say it is highly liquid. When there are few traders, it has low liquidity. Liquidity is one important way to distinguish between various available stock options. For every stock, there are hundreds of associated stock options to choose from. This is because of the large number of combinations of strike prices and expiration dates, but not all options are equal. Some are actively traded, while others are basically a ghost town. Liquidity matters most when you want to get out. If you're holding an illiquid option and decide to close your position, you can't just look at the last traded price and assume you'll get it. This is because of the bid-ask spread. The bid is the highest price someone is willing to pay for the option. The ask is the lowest price someone is willing to accept, and the gap between them is the spread. For illiquid options, there is less competition, so the spread widens. To get a trade done, you often have to settle for an unfavorable price. This results in a hidden cost called slippage. You lose money whenever you enter or exit a trade, simply because pricing is inefficient. For stock traders, liquidity is rarely a concern. If you want to buy or sell shares of a major company, you can usually find a counterparty in seconds. Option trading is different. When you most want to exit a losing position, you may find there's no one willing to take the other side at a reasonable price. This is why checking an options volume and open interest is not optional. Volatility measures the expected magnitude of price movement. It's about how large the moves are, not which direction they go. Volatility is a key factor in determining the price of an option. Other factors include the current stock price, the strike price, time to expiration, interest rates. All of those are observable. You can look them up. But volatility is different. It represents the market's collective guess about how turbulent the stock's price will be going forward. It's the only major input to an options price that cannot be directly observed. Here's what volatility looks like in action. When the market expects a stock to become more chaotic, option prices rise, not because the stock moved, but because the probability of a large move increased. This translates to more potential upside, as well as more potential downside, and that uncertainty has value. When the market expects calm, option prices fall, even if the stock itself does nothing. This is one of the most unintuitive parts of options trading. Your option can lose money while the stock price stays perfectly flat. Nothing went wrong with your directional view. The market simply decided that the future looked less dangerous than it did yesterday. A classic example of this is the implied volatility crush. Right before a major event, like an earnings announcement, uncertainty is high. Nobody knows for sure what the company will say. So option prices are inflated by that uncertainty. The moment the announcement happens, the uncertainty vanishes. And even if the stock barely moves in response to the announcement, the option price can still collapse. The volatility that was fueling the options price has evaporated. This is why experienced traders don't just trade price, they trade volatility. This next source of risk may surprise you if you have never studied the math behind option pricing, interest rates. They don't change very often, and for short-dated options, their effect is usually small. But they are still part of the machinery that determines option prices, especially for options with a far-off expiration date. Interest rates determine what is called the risk-free rate. This is the return you can earn by doing almost nothing, by parking your cash in a short-term government-backed bond. Think about what an option actually lets you do. A call option lets you delay buying stock. You get exposure to upside at a fraction of the cost. That means you still have some cash to work with. When interest rates rise, holding cash becomes more attractive. That's why delaying a stock purchase becomes more valuable, and why when rates go up, investors are willing to pay a bit more for call options. Now flip the logic. A put option lets you delay selling stock. It delays turning stock into cash. When interest rates rise, cash becomes more appealing. You want it sooner, not later. That makes delaying a stock sale less attractive. Demand for put options softens, and their prices tend to dip. Always ask, would I rather be holding stock or cash? A rise in interest rates increases the appeal of cash, even if only by a small amount. For most short-term option trades, this effect is minor, but for long-dated options, interest rates quietly become a real source of risk. We've talked about various risks like volatility and interest rates. Now, let's put a name to the triggers behind them. Event risk. Event risk is the impact of sudden discrete events. Some are scheduled, like earnings announcements. Others strike without warning, a surprise rate hike, a geopolitical shock, or a high-profile product failure. These events can trigger multiple risks at once. A surprise earnings report might spike volatility and move the stock sharply. A lawsuit can hammer confidence, driving down shares and pushing put options higher. Event risk is what ties these moments together. When you sell a call or a put option, there's always the risk that the buyer will choose to exercise. When that happens, you are required to fulfill your side of the contract. We call this assignment. You have been assigned. When a buyer exercises a short call, assignment means you are required to sell stock. In the case of a short put, you are required to buy stock. For American-style options, this can happen at any time before expiration if it's profitable to the buyer. And if you're short without having the stock or cash on hand, that's a naked position. Assignment risk is why naked shorts blow up accounts. If you're assigned without the stock or cash to back it, your broker will liquidate positions automatically at market prices with no regard for your strategy or timing. Surviving the options market starts with understanding risk. Stock options carry more layers of risk than stocks themselves. Ignoring them isn't trading, it's gambling. If you want to go deeper, our stock options course is built to teach these risks systematically before they cost you real money.